Loan Officer Training Series with the Mortgage Calculator. We'll wait just a couple minutes here to get started. Let everybody have a chance to jump on. Let us go live on all the different platforms. We do stream these live on YouTube, Facebook, and LinkedIn. We did put the chat up on the screen. Feel free to drop a comment there in the chat as you tune in. I see some people were already dropping comments there. Christina, Julio, Willie, Karma, Harriet. Thank you, everybody, for the comments. Feel free to keep dropping comments as you tune in. We'll get started here in just a moment. All right, Jason, Sandra, we appreciate the comments. Appreciate everybody tuning in nice and early. Nicole, thank you for the comment. Just one more moment and we will get started. Jake, thank you for the comment. Appreciate it. Susan, appreciate you tuning in and commenting. Hope everything is well. All right. It looks like we are ready to get started, so we can go ahead. We'll take the chat off the screen. Jessica, thank you for the comment there coming in from LinkedIn. Appreciate it. And we will get into it. So welcome, everyone. My name is Kyle Hiersche. I'm the COO of the Mortgage Calculator, joined here by our president, Nick Hiersche, and our sales manager, Jose Gonzalez. What we do every Tuesday and Wednesday evening at 7 p.m. Eastern time is go through a different loan officer training. Now, tonight is probably Jose's favorite training because Jose is Mr. Guideline. So our sales manager, Jose Gonzalez, with 28 years of experience as both a loan officer and a realtor, is very passionate about reading and navigating guidelines when it comes to putting together loans. So with that being said, I will turn it over to him. Let's talk about some guidelines, Jose.
Kyle, you're absolutely correct. I really enjoyed this one. This one is back to basics here, but it's basics kicked up a few notches because we all know in this environment that we're working in right now, you really have to have your A game. You have to be the consummate consultant to be able to thrive right now. If you're not adding value to the transaction, you're going to be left behind, right? Borrowers are being very picky who they decide to work with, right? It's not just about the rate. We have good rates at the mortgage calculator, but we have amazing MLOs that are great consultants, right? That's how we differentiate ourselves. And in order to be that consummate consultant, you have to know how to interpret guidelines. You have to know how to approach the guidelines. You cannot be intimidated by the guidelines. The guidelines are your friends. Unless you're intimidated, then you're not. It's going to be tough. But I mean, I love looking at the guidelines because they're written in black and white. I mean, there may be guideline interpretation variances. That's where we've been known to go to bat uh, with underwriters, where we may be on different sides of where we view the guideline to state, but we would not be there with a fighting chance if we were not passionate about reviewing guidelines and making sure that the guidelines are applicable to the program or option that we've selected. So, what I'm going to be doing tonight is highlighting certain points that you have to consider, which would be then reviewed in the guidelines, and then I'll show you. We'll do a little guideline delve in ourselves, right? So let's get right into it, right? So again, determining the correct path is the key, right? Are we going to go agency or are we going to go non-QM, right? I mean, I've added there the URLs for the guidelines for the agency products, right? Because Fannie and has their own guidelines. So whether doesn't matter who is the investor, they're all going to follow the same Fannie guidelines. Same as Freddie Mac guidelines, same as VA, same as FHA, same as USDA. There are not investor specific guidelines for agency, right? So those that are on our team, you have as resources all of these URLs easily accessible to you so you can review these guidelines. What does change from investor to investor on the agency loans are the overlays that they may add to their loans because they may be selling to a specific outlet, or they may only want to deal with selling specific loans. So, hence, FHA, for example, does not have a minimum credit score, but you know that the different investors out there have different minimum credit scores. Some will say 580, some will say 550, some will say 525, some will say 600. Whatever they have is an overlay, the same as VA, for example. VA will allow 100% cash out refi, but most of the investors cap it at 90. So that's an overlay that they add. So again, unless you're dealing with a manually underwritten product, where there's going to be a little bit of deviation there, you can note that all those guidelines are going to be pretty homogeneous. Whereas non-QM, being manually underwritten, they are investor specific, right? So considerations are agency or non-QM. If you are going non-QM, then you do got to really look at each investor's guidelines. Then are we going non-delegated, or are we going wholesale? If we're going agency, are we doing automated underwriting, or are we doing manual underwriting? Now, manual underwriting isn't for all agency loans, only specific ones like FHA, for example. But then again, you would go and look at their manual underwriting section of the guidelines. So let me just show you that a minute here, just so that you see. For example, I have, wow, that's a little bit big, right? Let's make that a little smaller there. So there we have our Fannie Mae selling guide, right? Sellingguide.fanniemae.com. That was a quick search online. There you have the Freddie Mac selling guide. They have the nice little search bar. We love those user friendly search bars. You can browse everything, but obviously the search bar right there. VA, again, they also have their search function right here. So that's our VA. They call it benefits.va.gov. That's the VA guidelines. And then FHA, oh, well, I logged in for too long, is the all regs. And, well, it's allregs.com. So you got those right there. And then USDA also with a search function right here. So you could search whatever you want to search: program services, resources. Again, a little bit more cumbersome to search these, but they're here, whatever you may need. So let me go back to my presentation, and then I will share the non-QM guidelines when we're ready to do a little probing around in there. Again, on the agency, when it's automated underwriting, it's a lot easier because AUS, the findings, are going to dictate the document requirements and the LTV and DTI limits. Because even though in theory you can look at a matrix for agency and it'll say minimum 620 credit score, right? That's in theory. You could go up to that 97% LTV on a first time home buyer with a 620 credit score. But in practice, it is what the automated underwriting is going to tell you. And automated underwriting is going to grab the whole picture, the credit, the income, the employment history, all that kind of stuff. And the algorithm is going to review it for the risk, and it's going to decide if it's going to accept your deal, how you put it forth. Maybe you have the deal at 49.8% DTI with a 625 credit score, and AUS says, eh. So now you got to lower the loan amount or purchase price or a combination thereof, however you're going to do it, maybe more assets. Could be a number of things. Maybe you're getting the deal with all gift and it wants more money from the borrower than from the gift. I mean, there's a number of variables that could affect how the algorithm views the risk, and you'd have to start adjusting those till you received your approved eligible. So with automated underwriting, with agency, little bit of a different ball game, right? But now in the examples that we're going to be in the analysis we're pretty much going to be doing here is we're going to be looking mainly at the non-QM realm where we are the AUS, right? We're the filter. We're the algorithm that's reviewing everything, and we're reviewing the guidelines of the specific investors. So again, you may have pulled up a quote or quotes, and you may have seen 3 or 4 or 5 possible candidates. And as you get more experience, those of you that may be newer to the business, you'll know who's good for what. But in the beginning, when you're looking at the options, it's not just going to be about the rate, especially in non-QM, right? Where every guideline is specific to an investor. In agency, it's a lot easier. You're looking at the options, you got 4 or 5 rate options. Your concern with agency more is going to be who has the quicker turnaround time on my purchase, right? Those are some of the things you're going to be considering with agency. Who's quicker turnaround on review? Who's quicker turnaround and review of the conditions? Who has a less complicated appraisal review process? Who has a less complicated condo review process? Those are the kind of factors that are going to be different from investor to investor. So when you're looking at agency, you're looking at more of that. When you're looking at non-QM now, it's a whole different ball game because not only are you considering those factors that we just discussed, rate plus turnaround time and the other things I just mentioned, but you're also going to be considering the actual borrower conforming to the guidelines of the investor that you are considering for the loan submission. So, what are some of the things that we first have to look at? Well, the first is just seeing what type of borrower we have, right? What is our borrower eligibility? So, you want to go into the guideline and you want to review the eligible and ineligible borrower types. Go right in there, search that phrase, eligible and ineligible borrower. So I'm gonna go a minute to my guideline here, right? And hopefully it'll cooperate with me. So you can tell last I was looking at foreign borrowers. So I'm gonna put eligible. Wow. Yeah, so we got eligible. Let's go with eligible borrowers. All right. So I got my ineligible borrowers. I guess I could have to. I'd have
And
to
that's
look at
it.
it. Yeah, no, yeah. Probably if I put eligible, then I'll probably get more of what I'm looking for. You just have to click through it a little bit more, right? So I guess they just show us ineligible borrowers, which is fine. So this is letting us know some of the things that we're looking at. So again, this is just to teach you all the theory of doing it, and you can go play around with the guidelines all yourselves. But that's what we would do. We would be looking at eligible or ineligible borrowers to see what we're dealing with, right? Are we dealing with a national borrower, right? That's going to require U.S. based credit and income. right? So is our borrower a citizen, right? Which would be one path. Is a borrower a non-permanent resident alien, which would probably be the same path as a citizen with additional documentation requirements like the visa and the work permit. They still got to have credit. Or is a borrower an ITIN borrower, which is they're a borrower that doesn't have status here in the U.S., but they're here, they're living here full time, they're working here. This is their permanent residence, so to speak. They just don't have yet their permanent residence status, but they do have credit. So that would be a different path then. And then you would go back to your guidelines and you would then search the phrase, you go control F and then you'd put ITIN to see what are the different requirements for an ITIN borrower, what are the different requirements for a non-permanent resident alien borrower, and so forth and so on. So now if you're dealing with a foreign national borrower, right, where no US based credit nor income is required, you're going to have different requirements again. So again, control F and put maybe foreign or foreign national. You got to sometimes play with the keyword because not every guideline is going to have the keywords the same. So sometimes you're only going to put maybe foreign instead of foreign national. Are you dealing with a non occupant co borrower, which is another important consideration because sometimes when you're dealing with non occupant co borrowers, there's going to be additional obstacles that you have. And I'm just curious on that one. Let me see how my guideline here has non-occupant, if it has anything like that. Non-occupant. Look at that. Non-occupant co-borrowers. Let's see what they say about that. Okay. Non-occupant co-borrowers are allowed. Okay. Blah, blah, blah. Cannot be the primary. Okay, so here would be the important point we would be consider, right? The non-occupant co-borrower cannot be the primary income earner, and they have to be an immediate relative to one of the occupying borrowers, either by family relation or marriage. So here we were going to use a non-occupant co-borrower. It can't just be a friend, right? So this would be the important takeaway from this guideline review if I'm going to use a non-occupant co-borrower. So it's all about the takeaway that, the key point that we need to consider. Then another thing on our borrower eligibility is, are we dealing with an owner occupied property or an investment property, investor property? The reason being, right, the rationale here is, and you'll review the guidelines and the matrices, because remember, sometimes the guidelines have the theory, but the actual numbers, the most updated LTVs and credit score requirements are going to be on the matrix, or if it's plural, matrices, right? That's where you really got to look. And I just found that out today as I was helping somebody out earlier. I not found out today, but an example today was we were looking at a guideline, and the guideline was talking about foreign national DSCR being capped at 60% max. They didn't change that from when they had cut it back during the pandemic, because that particular investor actually has DSCR foreign national at 70, as we confirmed by looking at their matrix. So the guidelines is mainly for the theory of what can be done, right? But the application of the theory, as far as the numbers, you would go to their matrix, or in some cases, they call it an eligibility table to confirm the max LTV, max DTI for property type, borrower type, so forth and so on. So these are some of the considerations that you would be exploring in your guidelines over borrower types or borrower eligibility. Now this is pretty obvious, right? But still, there are intricacies of each one. Are we dealing with a purchase or refinance? Again, the LTVs and the credit score requirements are different. Typically, cash out refinances are going to have lower LTVs and higher credit score requirements than a rate and term or a purchase, because they're just viewed as a riskier transaction. You're selling it essentially in a cash out transaction, you're selling it to yourself for a higher loan amount and you're pocketing the difference. It's a beautiful concept, but it does have a little bit higher risk associated with it. So, due to that, is why we would have to review the guidelines and the matrices to see what are the differences. Because not, and this is one here that really can stump a lot of people. Luckily, at the mortgage calculator, we have a lot of options for seasoning issues. Right? We have options where you don't need any seasoning on a purchase nor on a cash out refi. Right? So the seasoning requirements, like I mentioned, are more restricted for cash out refinances. Now, in most cases, you're going to have for a cash out refinance, first I'll discuss, you need to have usually a 6 or a 12 month. Now, that's non QM. If we go now to agency is going to require 12 months to allow you to use the appraised value versus the purchase price, and 6 months to even be able to do it, right? Um, Now in non QM, whole different ball game. We have the usual 6 months seasoning on a cash out to let you use the uh, appraised value versus the purchase price. Sometimes they don't even let you do it. Sometimes they'll let you do it with less than 6 months, but then they'll limit the value. But usually it'll be purchase price plus closing costs or purchase price plus repairs, depending on the option. Some have 12-month seasoning requirements, and some have no seasoning requirements as long as the borrower was on title at least the day before the application date. If they can prove they were already, vested owners the day before the application date, then there's no seasoning requirement. And if they got a really great deal on the property, and now they're like, Jose, I want to cash this one out because I want to buy two more. That's great. We can offer you a zero seasoning option for cash out refi. Now on purchases, believe it or not, also have seasoning requirements in the non QM world. In the agency world, no issues except for FHA. FHA, if it's a flip, they do require at least 91 days to have elapsed before you can enter into a contract on the property to begin with. And then they're going to have some additional requirements for possible additional appraisals if I think more than 20% increase in value. But in non QM, it's always going to be an issue, more an issue. Now we have our no seasoning option. Obviously, that is not an issue again. But with the majority of the non QM world, if the seller has been on title for less than 12 months, and you should, as your own QC, when you get a deal, the first thing you should do, when you're reviewing the property, is go into the public records to see when that property was last changed ownership, right? So that's when you're going to see when the current owner purchased it, right? Whether it's going to be a cash out refi or whether it's going to be a purchase by our borrower. You want to see when the seller purchased it. If it's been less than 12 months, look at the guidelines of wherever you're considering to see what kind of restrictions they have on flips. Some have it at 12 months, some have it at 6 months, right? Where then they may require an additional appraisal or they may require a CDA, right? Whereas the CDA is usually going to be required on most non QM loans. Not all. Now it depends. Now again, you got to look at the guidelines because some will say if you have a C on one unit properties, if you have a CU score of like 2.5, I can't remember now if it's above or below. You don't need a CDA, but if it's below, you do. And I think it's above. If it's more than 2.5, you need a CDA. 2.5 or below, you don't. So you got to look at that. And then if your CDA has more than a 10% variance from the appraised value, then you need a second appraisal, and then they go with the lower of the two. So all of those are things that I can't generalize and say that's how it is for the whole non-QM's realm. That's investor specific, right? To wherever you're submitting the loan. So these are all just different pointers that I direct you when you're, dissecting the deal, deconstructing it to, build it back better, right? So again, is it a purchase or refinance?
Hey Jose, real quick, when you're checking the property out and the property records, also a huge thing to pay attention to is the units, the actual type of
Oh,
home it
oh,
is, and the units is a big deal because that's what matters, right?
absolutely. That's what I'm getting at right here. You great segue into it. Absolutely, because a lot of times, and it's happened, where the MLO's talking to the borrower says, "Yeah, I have a great, it's a triplex, right, which is a 3 unit, uh, single family, three individual units, right, attached, detached, whatever. They're under one folio number." So they're talking, and everything's getting structured for a 3 unit property, right? Then nobody looked at the public records to see that it was zoned for 1 unit and not 3 unit. Then the appraiser goes out there, and you get the message from the appraisal management company, hey, we got a message from the appraiser that the property is actually a single family with 2 ADUs. How do you want to proceed? Boom, that's a hard stop right there, because now you have to start structuring your loan differently. You had it structured for a 3 unit property, which is something very acceptable. Now you have a 1 unit with 2 ADUs. So now you got to find an option that will let you use the income of 2 ADUs, right? So now you're in uncharted waters there. Now, if the property has multiple family zoning with the 3 ADUs, you're 2 ADUs, you're okay. But if it's single family zoning, they may let you use the income from 1 ADU, but they're probably not going to let you use the income from 2 ADUs. If they let you use ADU income at all, right? That would be the concern. So you'd have to start looking through the guidelines and calling the AEs, and that would be one. And we just had one like that. Luckily, though, in our case, the property was actually zoned multifamily, but it was a single family with 2 ADUs. It just happened to have the zoning for multifamily, so we were able to switch it, get a 3 unit uh, 3 unit property appraisal completed because it had been ordered as a single with 2 ADUs. So we switched it to a triplex, and it was fine then to submit to the investor as a 3 unit property. So that one had a happy ending. But if it was the opposite, and this could affect you also, like I just mentioned, and even ordering the correct appraisal. A 3 unit, I believe, is a 1025 with a 216 for the income and expenses, whereas the 1 unit with the ADU is a 1004 with a 1007 for the rental income, right? So that's going to change right there. So property type, obviously, you would go again to the guidelines, and you could search eligible properties or search ineligible properties, see what comes up, right? Again, we were mentioning single family with one or multiple ADUs could be area of concern. If it's a condo or a co-op, because they're totally different things. Condo is one type of ownership. Co-op is another type of ownership. Condos are there is financing readily available for condos. Very difficult financing for co-ops. Is it a 2 or 4 unit property? You got to know that because it's lower LTVs and higher credit score requirement. Is it actually a 5 unit property? Is it a mixed use property? And if it is a mixed use property, is it a commercial mixed use, like it has a retail and professional office, so it's a true commercial? Or is it a residential mixed use that you can use for one of the cool mixed use options that we have, where when you have at least 50% of the space in being residential, then it would be a residential mixed use, which would be a much more favorable product to finance. Is it a unique property? What am I talking about? Unique property? Well, like a geodesic dome, for example, or like an earth mound home, or one of these other real unique properties. If it's the only type of property like that in the area, you're probably not going to get financing for it. That would be one up to their call. Is it a manufactured home? Not a mobile home, but a manufactured home, right? That's a totally different property type than a stick built or site built home, like they call it, right? Manufactured home is manufactured at the factory, and then it's transported usually in two pieces to the site, and then the two pieces are put together, and then it's permanently affixed to the land, and then they give you an affidavit of a fixture, which means it's permanently tied to the land, and now it transitions from being a trailer, a vehicle trailer title, to a deed with a folio number and real estate associated with it. Is it a modular home, which is fine, but it's about the look of the modular home. Typically, modular homes look like regular site built homes. They're not a problem. But if it's too unique, so again, these are all things that you could search on the guidelines to see if they fall under the eligible or ineligible, and if they are eligible, under what requirements. Like, we do have investors that will lend on log homes, but they'll only lend on log homes if two of your three comps are other log homes, right? And they can't be 15, 20 miles away either. So yeah, they'll let you do it as long as you can provide suitable comps, because again, they don't want to be the unique property in the area. So here again, I'm giving you certain pointers, to enlighten you, and so you can go look at your in the guidelines. Now, credit. Obviously, credit is pretty obvious, right? But again, there are certain things that you have to consider when you're structuring the loan, which is what you're going to look into the guideline for. Now, again, on the agency loans, it's a lot easier, because agency loans rely primarily on automated underwriting for the credit determination, except for manually underwritten loans. So it's really easy on agency. You run it through automated underwriting, whether you're doing DU or LP. And if you get an approve eligible for DU or an accept for LP, that's it. The system tells you exactly what you need and what's acceptable, the document requirements, the DTI, the LTV, everything is there, easy for you. You just gotta read your findings and just follow the script. Now, non QM, again, it requires you. That's why our system really, you excel in non QM if you want to be a consultant, right? Because as a consultant, you're going to have to review those guidelines and see which is the one that best applies to your borrower's needs and objective, right? And not just the guidelines, but the matrices. And you're going to have to then look at credit score requirements, trade line requirements. And when I'm talking credit score, keep in mind and trade lines that in some guidelines, if the borrower has three credit scores, then you don't have to worry about credit depth. In other words, they don't care how many trade lines they have. They don't care if they're open or closed, as long as they have three credit scores reporting. So that's a pretty good workaround for a borrower that may have, great credit, three great credit scores, but no open trade lines, right? Or only one for 6 months because everything else they paid off. So we do have options for that. You just have to scour the guidelines and make sure. Another interesting point that could affect is rental or mortgage payment history, right? That is one that could, make or break your deal, especially let's say you're trying to structure a loan for a DSCR borrower, right? And you know that the best options, the best rates that we have for DSCR borrowers are where they can show a primary housing expense, be it rental payment or mortgage payment, and or they could, yeah, either rental or mortgage payment, and they could show that they own a property, right? That they're not a first time investor, is what I meant by that. So in that scenario, you're going to have the best rate. Now we do have options for a first time investor who's also a first time buyer who also does not have a rental payment history. By the way, it's the same option that allows you to do the loan without seasoning, and that option also doesn't source or season large deposits. Wow, right? Everybody's going to be wondering who's that one. Well, so again, though, when you are looking at the deal and you do see those 4 or 5 rate options, and you see the one that comes up at the top there, super low, it's like 7.75%, where the other one is 8.875. You're going to want to look and make sure that your borrower conforms to what they require. And these are some of the points. And then credit events, right? What do we mean by credit events? Foreclosure, short sale, deed in lieu, bankruptcy, those are credit events. Those are other things that you're going to have to look at. If you see them on the credit report, go look it up and see. And in the matrices, also look them up to see how that affects. And we touched base on this a second ago, but is your borrower a first time buyer or are they a first time investor? You can actually search these terms in the guidelines and it'll let you know if it's an ineligible borrower or if they can do it at a reduced LTV, right? That's the kind of stuff that you're going to find when you search the guidelines for these terms. Income. Now, income, another troublesome area. So, obviously, determining the income type or types, because we do have options where we can use W 2 income, bank statement income. We have one that you can use W 2, bank statement, P&L, and asset depletion all in the same loan from the same borrower. Now we have options, and I just disclosed one for somebody today where the borrower, the main borrower is bank statement, and the co borrower is W 2. In that kind of a scenario, the main borrower would have to be bank statement. You would not be able to have the main borrower be W 2 and the co borrower be bank statement. That wouldn't work. But that'll usually tell you in the guideline, the primary borrower, has to be the bank statement borrowers. So again, determining the correct income type or types is critical to ensuring you're on the correct trajectory. If not, you could be wasting time. If you're wanting to go full doc with traditional methods such as tax returns, then you review them, they don't look good. So now you got to go alt doc. So if you have a self-employed borrower, that's great because you could go bank statement, you could go profit and loss, you could go asset depletion that or utilization. That's not dependent on employment or income type, should I say? You could go DSCR, although that's for investment properties only. So again, any of those, you could search the phrase in the guideline of the specific investor and see all of the intricacies that they have on that product. And then you're going to review what are the potential issues, right? If you have a self employed borrower, they're going to need a minimum time in business. If you have a salaried or hourly borrower, you need to verify the required time that they've been on the job or been working. You need to verify usually at least 2 years of employment, not in the same job, but a 2-year minimum employment history. Now, I will tell you if your borrower just graduated from the university or some other type of certification course that they took that prepared them for their career, right? And maybe a 2-year course or a 4-year, university, college, whatever, that will count as what they were doing before they started working in their real full-time job. So you could have somebody just graduated as a respiratory technician or something like that, Maybe they were working some odd jobs here and there, but they were going to school full time for the last 2 years to get that certification. You could provide a transcript and their diploma, and then letter of explanation, and that would make up for that time. And then they would have 3 years, excuse me, 3 months in their current job. You would be able to close that deal. Variable income, such as commission, bonus, or overtime, is something also to be concerned of. And you could, if you go to Fannie Mae selling guide, you just put variable income in the search bar, and it's gonna pop everything out. Or if you go to your non QM guidelines, you're probably gonna have to search a little bit more specific, bonus, overtime, commission, tips, stuff like that, and you're gonna get guidance. 1099 borrowers, another issue, because some people consider them employees when they're not. They're independent contractors. Large gaps between jobs, so employment gaps. That's something else to be considered. An income that you would have to look up in the guidelines, or somebody that just switched from salary to 1099, or vice versa. That's another thing to be concerned about, that you could review guidelines. And our last category to consider is the assets for the cash to close, right? So you need to make sure where the cash to close is going to come from to ensure you don't have any issues, such as seasoning of large deposits, sourcing of large deposits, required reserves, right? Especially if they have additional investment properties, that varies. Some investors, and here I'm talking about the company that we sell the loan to, don't have an additional property reserve requirements. Others do. So you got to look at the guidelines and the matrices when you're looking at that, and gifts of equity from acceptable sources. So let me go a minute to the guideline, and let's just pop in, a couple of these phrases. All right. So if I were to put in here seasoning, that's probably gonna give me a lot of things. 20 items come up, right? So seasoning. So you guys get the picture, right? We do the control F, cash out refinance seasoning. Again, cash out refinance seasoning seems to be a popular one here. Bankruptcy, now seasoning of of their credit events. So again, you see the terminology can change from investor guideline to investor guideline. 4 months seasoning of asset required. I guess that's for asset utilization. And here we go again. Another 2 months bank statements, evidence seasoning, and we'll just look at the last three just out of curiosity. So less than 60 days seasoning requirements for a purchase rate and term, and assets and reserves. So you guys get the picture, what we're talking about here when we mean our seasoning requirements and how we review guidelines. So we have any questions here? I think.
We have one not really related necessarily to the guidelines, but Leonardo's asking, what is the difference between non-del and wholesale?
All right. Non-delegated correspondent is where we are the lender. And when we are the lender, non-delegated correspondent, we disclose the file, we generate the documents, the LEs, the initial CDs, the closing package, and we fund the loan. Wholesale, we are a broker. On a wholesale deal, we're just a broker. They're the lender. We don't fund it. We don't disclose it. The non-del deals, our MLOs review with our disclosure desk for disclosing, and the broker deals are reviewed with the team leader only.
So non-del is when we're the lender.
Yep.
Wholesale is when we're just brokering a loan like anybody
Yep.
else.
Non-del, we got better pricing too, and quicker disclosures. So we got a question here. What if an extra unit slash ADU is not permitted, but zoning allows it? Have you ever seen any investors allow use of income for DSCR purchase? Yes. The critical component here is if it's zoned for it. That's the first hurdle. Now you have some cities now and counties that have passed ordinances due to the crunch on housing where they are allowing ADUs with certain, obviously certain restrictions, but they're allowing ADUs in single family zoning. So you're going to have to reach out to your realtor partners for that type of hyper local information to see and to provide you guidance. Because I know, for example, where I live in Miami and Miami-Dade County, the city of Miami allows it, and Miami-Dade County also allows it to add one ADU to a property, either attached or detached, but they do put certain requirements. So, yes, they do allow them. Now, if permitted or not, that's going to be up to when the appraiser goes out there. They don't really look at public records to see if they have permits for an ADU, but if the appraiser makes any note on the appraisal regarding the quality of the work, if it's shoddy workmanship, if it looks like it's not to code, stuff like that, then and if any comments are made in the appraisal like that, then there's a good probability that it is going to be flagged for providing documentation proving it. But more importantly, to know what will and will not be considered is you do have to see in their guidelines to see if the investor allows the ADU to provide income. Because again, the fact that they accept the property with an ADU doesn't mean that they're going to allow the income from it. And that is very investor specific.
All right, looks like we got some more questions rolling in here. Good stuff. So Alex is asking, when referring to a seasoning period, is that just referring to a specific time frame or requirement? So just in general, what are we talking about
The
when you're saying?
seasoning period, okay, depends what we're talking about. And here now, if we're talking about a purchase, right? We would be concerned with how long did this has the seller been on title on the property that he's selling. That would be the seasoning period of the seller being on title. If it's a cash out refinance or just a refinance in general, how long has the owner been on title from the time that he was entitled to the application date, because the date of the application is the cutoff, not when you're closing, because that happens where okay, he's 5 months now at application, but when he closes it'll be 6 months. No, it counts the application date. So that would be the seasoning period then. That for a cash out refi is what you would be concerned. Seasoning period on title of the owner.
Also, things that we were talking about, such as seasoning on funds, right? How
Right.
long have they been in the bank account before the actual date of needing to be used,
Yeah.
right?
Right. Or seasoning on a credit event.
Right. Okay, looks like another question here. Um, when a borrower has recently completed the certification of trade, the time working while going to school can still be used for work history requirements.
Well, if they did like a 2 year deal or actually went to a college or university for 4 years, you won't have to really worry about having to provide a work history. Now, if they were working during that time, and fine, you're going to have tax returns and all that, but the clock is really going to start ticking when they graduated and got their job in the career that they studied. That's the whole key. Now, if they went to nursing school, right, or if they got a degree in nursing and all of a sudden they're working in something unrelated to nursing, you're going to have an issue. You're going to have to provide then the 2 years work history. However, If they graduated with a degree in nursing and they're not working as a nurse and they've only been working for 2 months, that's fine. You'll be able to close that deal with only 2 months experience, as long as you have either that 2 or 4 year proof that they were going to school for the degree or certification that was required for them to be able to work in the job that they're now working. That's the key. You gotta tie it all in together.
All right. I don't see any other questions. I guess we'll leave everybody with what Jose says: guidelines, 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 right? Especially for people pricing loans, quoting loans. These pricers and quoters are not looking at the guidelines, right? You have to check to see if the loan actually fits the guidelines, not just the credit score, the LTV, all this kind of stuff, right? Very important.
Yeah, you don't want to sour the deal by going off on a trajectory that now all of a sudden you have to change course, usually going to mean resubmitting the file to another investor. There's usually going to be a delay to the deal, which your borrower is not going to appreciate. You could lose credibility. You could even lose the deal. So that's why it's so important to try to get it right the first time.
All right. Well, thank you everybody for the questions. We appreciate that. Remember, we do this every Tuesday and Wednesday, so we will be right back tomorrow at 7 p.m. Eastern with a new topic here. We appreciate everybody tuning in. Thank you, Nick. Thank you, Jose. And we'll see everybody tomorrow, 7 p.m. Eastern time, for the next episode of the Loan Officer Training Series with the Mortgage Calculator. Have a great night, everyone.